Let's go to Florida.
What if I told you that some of the hottest housing markets in the United States right now could become the biggest losers by 2026?
For the past few years, we've seen an unprecedented housing boom. Home prices surged, bidding wars became normal, and people rushed to relocate to fast-growing cities. It felt like prices would only go up. But that narrative is starting to change. Behind the scenes, the market is shifting. Interest rates are higher, affordability is shrinking, inventory is rising, and the migration trends that once fueled growth are beginning to slow down. And here's the reality: real estate markets don't crash all at once. They crack slowly and then suddenly. In this video, we're breaking down 5 cities where home prices are at the highest risk of crashing in 2026, based on real economic signals, market trends, and structural weaknesses. Make sure you stay until the end, because the number 1 city on this list is one of the most surprising and potentially the most vulnerable. Let's begin. Starting with number 5, Tampa, Florida. Tampa was one of the biggest winners during the pandemic housing boom. People moved in from expensive states, remote work gave buyers flexibility, and demand skyrocketed. As a result, home prices in Tampa increased dramatically in a very short period of time. At first glance, that might seem like a sign of a strong market, but when you look deeper, you start to see the imbalance. The biggest issue is affordability. Home prices have risen much faster than local incomes. This creates a gap, a dangerous one, because eventually local buyers simply cannot afford to keep up. And when affordability breaks, demand weakens. We're already seeing early signs of this. Homes are sitting on the market longer, inventory is increasing, sellers are beginning to reduce prices. Another major factor is interest rates. Higher mortgage rates have significantly reduced purchasing power. A buyer who could afford a home 2 years ago may no longer qualify today. And then there's the insurance crisis in Florida. Rising property insurance costs are quietly pushing total homeownership expenses much higher. For many buyers, this is becoming a deal breaker. So when you combine rising costs, weakening demand, and increasing supply, you get a market that is shifting from growth to stagnation and potentially to decline. Tampa isn't collapsing yet, but the foundation is clearly weakening. Now let's move to number 4, Phoenix, Arizona. Phoenix is known for something very specific in real estate cycles. It goes up fast and it comes down fast. During the housing boom, Phoenix experienced one of the fastest price increases in the entire country. Investors flooded the market, new construction surged, and demand seemed unstoppable. But markets driven by rapid growth often lack stability. What we are seeing now is a classic reversal pattern. Inventory is rising again. Builders are completing projects that were started during peak demand. At the same time, buyer activity is slowing due to higher borrowing costs. And here, where things get risky, investor demand is fading. A large portion of Phoenix's growth came from investors looking to flip homes or generate rental income. But when financing becomes expensive and price growth slows, those investors exit quickly. That creates a sudden drop in demand. On top of that, Phoenix is highly sensitive to interest rates. Even small increases can significantly impact affordability and buyer behavior. Historically, markets like Phoenix don't correct gently. They tend to swing hard in both directions. And based on current conditions, Phoenix is showing early signs of entering a downward phase. Next, number 3, Austin, Texas. Austin became one of the most talked about housing markets in recent years. Fueled by tech expansion, startup culture, and massive migration, the city saw explosive growth. At one point, it felt unstoppable. But rapid growth often leads to overextension. Home prices in Austin rose so quickly that they outpaced what even high-income buyers could reasonably sustain. Now we're seeing the consequences. Inventory has increased significantly, builders are offering incentives to attract buyers, and prices in some areas have already started to decline. One of the key risks here is the tech sector. Austin's economy is heavily tied to technology. If hiring slows or layoffs increase, housing demand can drop quickly. Another factor is overbuilding. During the boom, developers rushed to build new homes to meet demand. But if demand slows while supply continues to rise, prices come under pressure. And that's exactly what's happening. Austin is not just cooling, it's actively rebalancing. And in many cases, rebalancing means prices have further to fall before the market stabilizes. Now let's talk about number 2, Miami, Florida. Miami is a unique market. On the surface, it looks incredibly strong. Luxury real estate is booming, international buyers are active, and demand still appears solid. But beneath that surface, there are serious structural risks. Unlike many cities, Miami relies heavily on external demand. That includes foreign investors, wealthy buyers, and people relocating from other high-cost areas. The problem is, this type of demand is not stable. It can change quickly based on global economic conditions, currency fluctuations, or shifts in policy. Another major concern is climate risk. Rising sea levels, increased flooding, and stronger hurricanes are not future problems, they're current realities. And they are directly impacting the cost of owning property. Insurance premiums in Florida, especially in coastal areas like Miami, have been rising sharply. In some cases, homeowners are seeing massive increases in annual costs, which reduces affordability and discourages new buyers. Then there's the affordability gap. Local incomes in Miami do not support current home prices. That means the market depends heavily on continued external demand. If that demand slows even slightly, the impact on prices could be significant. Miami isn't weak yet, but it is highly exposed. And finally, number 1, Boise, Idaho. This is the market that shocked everyone during the housing boom. Boise saw one of the most extreme price increases in the country. In a very short period of time, home values skyrocketed far beyond what local fundamentals could justify. And that's the key issue: fundamentals. Boise does not have the same level of economic diversification as larger cities. It doesn't have massive job growth engines or a high-income base to support elevated home prices. Instead, much of the demand came from migration, people moving in from more expensive areas. But that trend is slowing. As interest rates rise and affordability declines nationwide, fewer people are relocating. And when migration slows, markets like Boise feel it first and the hardest. At the same time, local buyers are already priced out. That creates a situation where demand drops from both sides. Add to that a growing supply of homes and reduced investor interest, and you have a perfect setup for price correction. Historically, smaller markets that experience rapid booms tend to face the sharpest declines. Boise fits that pattern almost perfectly. So what does all of this mean? The housing market in 2026 is unlikely to move in one single direction. Instead, it will be divided. Some cities will remain stable, others may continue growing, but the markets we discussed today share common risk factors. Rapid price growth without income support, heavy reliance on migration or investors, rising ownership costs, and weakening demand. These are the ingredients that create vulnerability. If you're a buyer, an investor, or just someone watching the market, understanding these patterns is critical. Because real estate is not just about location, It's about timing, economics, and sustainability. And right now, those factors are shifting. One final insight before we wrap up. The next phase of the housing market will likely be more localized than ever before. National headlines might say one thing, but what really matters is what's happening in specific cities, neighborhoods, and price segments. That's where the real opportunities and risks will be. This video is for informational purposes only and should not be considered financial advice. Housing markets are complex and influenced by many unpredictable factors. Always do your own research and consult with professionals before making any financial decisions.